Everybody, good morning. Good morning. It's Sunday, August 30th, and good evening to you folks out there in different parts of the world. Okay, so I want to get into a soybean oil future spread and a couple of discussions why I want to bring this up. One, it's a really good trade idea for people that are starting off, that have futures experience but want to be able to swing trade and have a cost-effective way of trading futures by using a style and method we call future spreads. So soybean oil, any of the grain markets have been really, they're the most affordable things, the good way for beginners to start doing spreads. They have a good liquidity in them. Their tick sizes are they're affordable, versus some of the other spreads out there that can get pretty expensive for a beginner to learn off of, like such as energies, and even some of the meat agriculture, which is pretty, it can get pretty intense and can gap a lot and things like that. So in this case, using soybean oil future calendar spread as an example, we're just taking 1 month of soybean oil future, like a standard future contract. We're either selling or buying the front month, and then we're buying back, a following month, and then how much we also determine the movement of that is by how far out we spread those months away from each other. So in this case, we're looking at a December versus March of next year soybean oil spread. So it's ZL Z as in December 20 versus ZL H21, H for March and 21. So, and in our group recently, we had a good sell opportunity come up on the seasonals inside of this one platform we use called Season Algo. There's a lot of platforms people use to identify seasonal opportunities. Guys, be aware, if you don't have any experience, don't do it on your own. Get some little bit of formal training on how to use it. So, and obviously we had a rally up. We've been seeing a lot of these seasonal entries that have been recommended by these algos, not always happening in the beginning the way they are intended to do. But why? This one is because we've had recent weather issues again. This time of year, grain markets either get too much water or too little water, and some areas just get blasted by weird tropical random storms. And so we've just had a little bit of an event. And, it happens. But looking at a technical area, I'm just looking at to see where volume has hit up here before. This is a line chart. We're looking at up to 15 different years of historical probabilities and where these markets have gone before. So, chances are, the big commercials and the big um, speculators out there, the way that they turn these markets against each other, they buy and sell amongst each other, we should see a big selling coming here into this soybean oil contract. So why it didn't happen is obvious, we know, but on a technical level, we see this area hit here before. My target area I want to make is the same area here where we see volume is hit before. It's done it in the current month, current spread, which is the black line, and then in the past 5 years area, we've done that before here. So a good average area would be here. If you look at my target zones, I'm about $240 to $300 target, and maybe if it breaks out and keeps going against me, I might want to risk only 50. So in this case, we have like a 6-to-1 risk to reward, right? So you kind of know that you can use risk to reward here, um, but it's a good probability area, or you can go 100, which is your max. Risk 100 to make 300, and now you're at a 3-to-1. So you could still stretch that. Okay, so this is the idea that I'm looking at for soybean oil. Now, what kind of a margin does these cost? I want to pull up the span margin calculator real quick, and I'm going to create a new one. And I have a separate video for those of you that want to learn how to use span margin calculator, the downloaded version directly from CME. It does a lot of the math for you. You just got to do a download, every few days to get the right margin. If you're intraday trading, you'd want to download a zip file from the CME directly, and it's completely free. You just got to sign up a user account, and then they'll give you a link. You can use that. I have all the instructions in a video. So in this case, I'm just gonna go put whatever here, soybean oil, and that's just so it allows me to get in here into the positions. And if we have the 4 different markets from CME exchanges, the CBOT, CME, COMEX, and NYMEX. So we're gonna stay in CBOT here, and we're gonna go ahead with soybean oil futures, and some of these things are coded. We're gonna sell one. Now look what happens when I want to only sell one. The margin on this thing is about $715 to carry this over one overnight. Okay, remember day margin 650, maintenance total 715. Now, what happens if I add a second contract? Because the exchange knows that this thing could be so, um, let's say, uh, less risk because we're hedging our position with the same exact product, just a different month. When we change, oh, hold on, guys. All right, so let's try this again. So when we bring back this contract that we only picked one on, we only picked one, we sold December. We come over here and we just want to add one of March, and we hit calculate. Now we're only down to a $61 margin. That's pretty low, right? So you have to ask yourself why. Well, there's a chance that you're just not gonna make. You saw the risk to reward I showed you. You're gonna make a little bit less than what somebody that was trading the outright could make. Somebody trading the outright has the chance to make 3 or 4 times that amount. No, that just depends on which market, which instrument you're looking at. But it's a safer way for beginners that want to come in, check out the future spreads markets. I have a whole webinar on it. We teach people. We have a group. It's pretty affordable too to figure it out and learn it. And we coach you through this process. But basically, again, my point, not to make this a sales deal, is using the right tools, we can find good opportunities. So, again, we're at a good place here where I find soybean, um, the whole soybean market itself is probably facing this high resistance zones. This is just oil, soybean oil by itself. Again, December versus March. Now, I have another strategy that I teach people. Okay, we just don't lean into seasonals. We start off with seasonal, but we use technical ways to actually offset if there are any losses using a technical approach that I do with trend following and such. And you can actually in these products that do have good volume, you can trend trade these things. So I also teach that. That's my actually go-to strategy that I like to do when things don't work out on a seasonal. It's not just about seasonal, guys. It's just an opportunity to find something and learn the market, and then we can use trend strategies, um, because a lot of these spreads tend to trend a little bit better than the actual outrights themselves. Let me show an example. Now, in this example, and the market's closed on Sunday still here, so we can't see the volume on the depth of market and all the volume on the calendars, but we're looking at a calendar inside of Futures Plus, on a daily chart of this spread. Okay, and excuse the dog, guys. So we see that we went, overall, we were attempting to start selling off. We went sideways, and the price started going up last week or two, based on whatever's going on out there I mentioned earlier. I break it down, look at a smaller time frame, and we can see on 150 constant volume bar, again, where when these things break out, you can ride these trends. So, on the 24th or so, um, soybean oil and all the other soybean products made an uptrend. I had sold just this short amount here on soybean myself, saw this little resistance area, saw that market was about to stop. And so we're using technicals on spreads. If you can do it, if there's enough volume to chart it. So this isn't the cleanest one in the books, but just using that and maybe a simple indicator like ADX, we could even see exactly where the market confirmed and turned and went to the longer side. So we're looking to see, you know, um, we're looking to see this max area here turn back around on a technical level. And if it doesn't, then we want to look at different technical options. So this is just a idea how to use, not the cleanest idea on the technical charts here on this particular spread, but just using these line charts alone on season algo. If taught right and you know what to look for, you can take advantage of this opportunity, at times, not even really looking at another chart, because this within itself is a line chart. So, and it's mirrored again um, over a lot of different years. So I think that's about it here. We'll wrap this up, and this is the trade idea for the week. Again, we're going to take another stab at soybean. We're not going to give up. When something doesn't work out, we'll just get out. We can use our second option, trade the trend, or just leave it alone, come back and revisit it later. Two different ways to trade it and get involved in future spreads, guys. Have a good week.